Let's look at principle one then, the end of a rising market. An up bar on a narrow spread. Now the narrow spread is the most important part here, okay? That's very, very important. It has to be on a narrow spread, close on the middle or low, volume very high or stronger if ultra high. Weakness always appears on an up bar because professional selling has to sell into a surge of buying. The narrow spread indicates supply. Something has put a lid on the top of the market. Selling or lack of demand from professional money are the only two things that can do this. If the volume is ultra high, this will show a serious sign of weakness. This sign of weakness needs to have the following criteria. Okay, so pay attention to this because this is a very strong sign of weakness. The high or ultra high volume up bar, now an up bar, remember, is a price bar that closes higher than the bar behind it, must be into fresh new ground and will have a strong bull run in the background. That's important. It must be in a strong uptrend to be the end of a rising market. We don't want to see this where there's price action to the left, although occasionally you do see it. We really want to see it to be a strong sell signal right at the top. The price range or spread should be really narrow, and I'll explain in a minute with Philip why that is. The example we're going to show you is one that I've shown several times, and I'm going to show it today because it's such a good example. It's the US stock of JP Morgan Stanley. It's a very narrow range, and in fact the day in question that I'm going to show you, which was the 14th of October last year, it was within $1 for the range of the day. That's very, very tight. The spreads were usually much bigger on that stock, and it really was tight. Now the news will be good, as I'll show you, and that's going to be to mislead you. You will have the urge to buy this because the media, brokers, everyone will be recommending this as a strong buy, possibly even IBD, when in fact you should be not buying this stock. Indeed, you should be looking to sell it. Now, when we see this indicator, again, it's going to be difficult for you to spot it at the right edge initially, because your gut reaction, which is what causes most traders to lose money, will be to buy it because of everything you hear. But Tom, when we see the end of a rising market like that, you yourself, when you're a syndicate trader, if you wanted to distribute to the herd, you'd make sure there was a very good rumour out there, or you take advantage of good news, correct?
Oh yes, definitely. And don't forget, the end of a rising market is usually gapped up. Again, it's probably gapped up in the cash market, with the specialists and the market makers gapping it up. The spread is narrow because they've gapped it up, and as soon as the public rush in and start buying buying the stock, then of course because the constant supply is coming in from the professionals are unloading, then that caps the top end of that bar.
So basically what you're saying there, let me be clear, for every buy order from the herd who are rushing in, these professionals who've brought at much lower prices are just saying, hey, thanks very much, here, take it.
Yeah, take it.
At this high price.
Thank you very much for your cooperation. Yes, and you see, again, it revolves around the mentality of the herd. Right at the bottoms, if you think back some months ago when they were talking about in England a meltdown and all this terrible words were coming out, I know Philip went in and bought, but most people would not buy. They say, well, you're mad, I'm not buying now, I want to see what happens. And then the market starts moving up very rapidly, and eventually they will want to start unloading or taking profits. And that's what usually happens, is you see a gap up, the news is good, narrow spread. If it's in new high ground, or even fresh new ground, you can absolutely guarantee that that's the top of the rising market.
Now we talk about fresh new ground, and I say finally here, if the market is gapped up and is approaching or at previous resistance levels, then this is an even stronger sign of strength. Now, Scott's one step ahead of the game here. He says, well, this must be around the news reports. Well done, Scott. You're very alert today. Scott has had his Weetabix and his coffees today, because look, this is the 14th of October. Indeed, you're correct. This is the earnings from JP Morgan. Now, this is great news, Tom. I mean, come on. They've just had their biggest quarter. I mean, the earnings are superb. The fundamental analysis is spot on.
Yeah.
This is a bullish stock. It's been going up. The banking sector will lead in the sector here.
Yes.
Now, come on, you're telling me that this is a sell.
Yeah.
Oh dear. Okay, well, let's have a look at the chart. The chart never lies. Okay, now you told me that when I first got involved with this. You said, Gavin, if you want a friend in the stock market, buy a dog.
There were no friends in the stock market.
And they said the reason so many very clever individuals fail is that the information that's coming into them from, not deliberately sometimes, I mean, this was good earnings. That was true. They're not making that up. But the gut reaction from any uninformed trader, and of course everybody in this seminar is becoming informed, and I call it waking up to reality. It's the market mechanics, as Jim Cramer calls it. Jim Cramer did several interviews on YouTube. Some of you may have seen them. And he talks about the mechanics of the market, and he talks about the shenanigans that go on. We call it just outright market manipulation. We don't mince our words here at Trade Guider. But here we see this very, very high volume. Now notice here, this is the actual chart on the day of the news release. If you look here, the date is the 14th of October. That's the same date that the news was released. Now we notice the volume here. Now look at this. I always call this Shaq O'Neal. And why do I say that? He's a famous basketball player, by the way, Philip. He's very famous. He's about 7'6", I think. But Tom used to say to me, well, from a VSA perspective, we are not looking at just normal volume. We're looking at relative volume. So I said, well, what do you mean by that, Tom? And I understand relative. And he said, well, relative to the previous bars around it. And this is why the human being is always better than the computer, because we have eyes and a brain. And computers have somewhat limited things that they can do. So, and I said, well, I still don't understand relative. He said, well, you live in Chicago. Imagine you were walking down, walking down Michigan Avenue, and an alien lands at 6 o'clock in the morning. There's no one else around. And he says, Gavin, how tall are you? And I said, I'm 6'2". And he said, I've got nothing to compare you to. So then I get Shaq O'Neal to stand next to me, and there's a friend of mine who's a jockey, lives in the same building. He's 4'6". Now, if I put him next to me and I'm 6'2", I'm going to be fairly tall. The jockey's going to be fairly short, and Shaq O'Neal's going to be this volume bar right here. Okay, so there's Gavin, there's the jockey, and there's Shaq O'Neal. Now, trust me, when you see Shaq O'Neal on a chart, as we're going to show you today, your trading antenna must go up and say, what the hell's going on? In Chicago, they said this saying, what's going on? Well, I always now use that as a little trigger in my brain when I'm trading. As soon as I see ultra high volume on an up bar, or indeed a down bar, I say, what's going on? And from that, I then let the story unfold, because often you cannot take the trade immediately, as we're about to show you. But when you see good news, you wait after you've seen the high volume for the VSA setup to appear. And as we've seen, Philip, sometimes it's immediate within 3 bars. Sometimes it takes 25 to 30 bars. And today we're going to show people in this seminar where to look and where to see a clear, quick entry where you have to be patient. Most traders that are unsuccessful are not patient. Okay, so first of all, we look at this stock and we go back to the 30th of September 2008. Lesson number 1 here. Always look at the big picture on your chart. Put up at least 200 to 300 bars, or even more if you can, to see, okay, this is important, to see, do you have unusual volume in the past, or do you have an old top to the left that you're approaching? Okay, I know I will answer. I mean, Morris, I will take the question here because I know the answer. Tom, if you saw the end of a rising market, would you short that pretty much instantly?
I personally would, yes.
Yes, I know you would. And you wouldn't put all your house and car on it, would you?
No.
I've been training him. 2.5% of your capital in any one trade, correct, Tom?
That's right. That's dead right.
That is dead right. But I will tell you, ladies and gentlemen, the previous seminar that I did with Tom some years ago, we were in, I think it was London, wasn't it, at the Technical Analysis Society here.
Yes.
And Tom stood up, he said, right, if I see that, yeah, I'd mortgage a house. He hasn't got no mortgage, but I'd mortgage a house, sell the car, and put everything on the trade. But of course, we teach you, you've got to always be cautious, okay, and never risk more than 2.5% of your overall capital in any one position. Philip, you're a fund manager, you're managing other people's money. Is that the sort of advice you would be giving to potential traders and investors?
I don't think I'd mortgage my house on it either now.
No, but from a point of view of risk management, how much would you put, if you're managing £100 million, on any one position, what percentage-wise, what would you risk?
Well, I think the first thing you've got to decide if you're a fund manager is how many stocks can you actively manage and keep a close eye on. That's the biggest problem. The more stocks you cover, the more thinly you're going to cover them.
Right.
So I would say, I mean, there isn't a set sort of specific number really that you can give, but from my point of view, I should think in an average portfolio I wouldn't want more than 50 or 60 stocks.
Okay.
Because if I have more than that, it starts to get difficult to manage them all.
Yeah, it's interesting. We often get asked the question: how many instruments should I be watching to make money? And I always said, well, look, market specialists specialise in one stock. Often the specialist, like Goldman Sachs, the stock will have a specialist that specialises,
yes.
or there'll be a syndicate that specialises in it, and they make money because they know exactly how that stock moves and they can read the chart. So you don't have to follow thousands of stock. Having said that, we know that high probability setups like the end of a rising market, for instance, will appear, and in the new scanner that we've got, that you and I were going to be working on, we're going to be starting to look for these setups in a scanner which will scan multiple stocks, which will be a benefit to everybody. But I would still urge people to select a smaller portfolio to start with.
Oh, definitely. Yes. I mean, if you're managing for yourselves, probably you want, well, it depends again on the amount of capital you've got, but probably initially perhaps follow 5 to 10 stocks.
Yeah.
When you become familiar with those, you can always expand it out. And this is where I find the Trade Guide end of day software is very good, because I can go through there, use the sidebar on the left, and I can immediately see any stocks that are coming in with ultra high volume.
Yes.
I can make a note of those. They go in my list to keep an eye on. And if I see testing or no supply back into the same area in the future, then I've got a golden opportunity. But I don't need to go through every single stock, because the computer's doing a lot of that work for me.
Yeah, because the computer can pick out unusually high and unusually low volume.
So I let the computer do the work it's good at doing, and it leaves me free to do the part that I'm better at doing.
Which is making the trade, making the investment, and then managing the portfolio.
Yes.
Yeah, that makes sense. Now, here on this chart that we're looking at here, we see this old resistance level to the left. It was actually September 2008, and now we've gone up to it on an end of a rising market. And, you know, when you see that, on a chart, if you wanted to take an entry there, then you'd put your stop above the previous resistance level to the left here. Because there is sometimes an occasion, it's happened to me before, where you see the end of a rising market and the very next bar there's an upthrust, because they're devious, which is why I always tell people you just need to be a little bit patient. So that's down to your decision. But this is where I like to trade this indicator, because it's far more low risk after you've seen it. So you wait for the market to roll over, almost like the top of a mushroom, okay? So, and we'll show you that in a second. We must see the downtrend forming, because I'm a trend trader, and we encourage you to trade in harmony with the trend of the price, because then you're swimming with the river and not trying to swim against it. If you swim against the river, you're not going to go very far. But if you jump in the river and you're swimming with it, you move much further. So always try and trade in harmony with price. Look for the market to make lower highs on the price bars. I'll show you that in a second. As the market falls, we've got to look for serious signs of weakness, like what we call no demand, which we'll talk to you about in a minute, or an upthrust. Either of these indicators, after you see the end of a rising market, are very high probability entries to the short side. So here is the very same stock from a much bigger view. And I want you to notice this actually was taken, the chart was taken yesterday, so it's right up until yesterday's chart or yesterday's close. We ignore the volume at the right there because it's from eSignal, and their end of day charts don't update for a day, so ignore that is not ultra high volume on the right there. But we do definitely have very, very high volume here on this down bar, okay, which happened a few weeks ago, and that can be weak, okay, and we'll talk about that later. But up here, which was about the early part of January, we see that there's the end of the rising market here. You can see the top of the signal, and you can see the mushrooming over of the chart here. See that? Tom, can you explain why these charts mushroom over like that?
Well, they mushroom over because once the initial bout of selling has taken place, in other words, with the high volume up bar, then they have to support the market slowly, and so they can distribute more on the next wave up. Right. And give it time, because they're distributing, it will give this mushroom shape. And very often you can see a lot of the up bars are on no demand in these weak markets. And that's why it mushrooms over. And funny enough, the bottom is the opposite. You get a saucer shape at the bottom.
I noticed that. It sort of comes up and then, yeah. Why
Yeah.
is that?
Well, because you're just reflecting the buying in the saucer shape, and you're reflecting the selling in the mushrooming over.
Right. So basically, when we see a chart that's got a mushroom top, we need to be looking for shorts. And in converse, if we see a chart that's almost got this saucer shape to it, which is the opposite,
Looks like
then,
buying.
and then we want to be looking to buy that as it comes out the other end of the saucer, so to the right-hand side of the saucer as you were looking for it. So here, we're looking for sell opportunities in these regions as we come down because we're in harmony with the trend. And notice, look, the trend, when we see a trend, you'll notice we get retracements. Why does the market retrace like that, Philip? Is that professional money supporting the price at certain levels because they can't just let the thing collapse?
It may be that, and it may just be that the index might be strong at that point. And I think Tom's expression is it all boats float with the rising tide?
Yeah, all boats rise with the rising tide in the harbour. And they also sink down in the tide going out in the harbour. And you'll find that that's why, look at the index, the parent index is so important. And of course, we'll get into all that later, where you're looking really for stocks that are acting stronger, or at least as strong as the index. But we can cover that some later date.
Yeah, that's a separate thing because there's a lot of traders in here that don't just trade stocks. We saw the mix
Yes.
from the survey. We've got about 60% here are stock traders, but we have forex traders. We have some metals traders in here. We have quite a mix actually. Forex, of course, currencies. And we're covering all these charts, but I want to be clear, and I think, Philip, we want to reiterate, all the principles we're going to teach you today apply to any liquid market where there's volume, correct?
Absolutely, yes.
Because people find that difficult.
Yes. I mean, one other thing I would just point out, if I could, on that chart, probably the distribution started back in August. There's some high volume up bars just to the left there of where you are. That's the spot. That's probably the start of distribution. Remember, not all the professional groups are going to distribute at the same time. They're not in league with each other. As Tom says, they don't like each other. And you may well have seen one or two professional groups moving in there and starting to sell. The others saw that, and as the price went up, perhaps on some good news still, and the market was still trending up, they then took the opportunity to get out themselves.
Okay, so let's
probably
look at,
thought we sold at a better price than our other groups. Well done.
yeah, indeed. Now let's look at a place where we'd actually take a trade here, because this is something I've been talking about for some time in my seminars. Now we notice the end of a rising market's back here, okay, and the market falls instantly. I mean, it did plummet fairly quickly because of this very high volume, and it's a gap up bar. But I want to talk about the spread quickly of this bar. It's almost like, Tom, we talked about we call volume spread analysis, because you're looking at volume, price spread, and the closing price. And the spread here is the high and the low on that bar. It's within $1 for the day, okay? In fact, you can see, in fact, I haven't got my cursor on that bar, but it's very, compared to all the other ranges or spreads, it's very narrow. The next bar, though, is a clue. It closes dead level with that bar. Absolutely dead level. Now, if there was professionals buying into that volume, surely it wouldn't close level, it would close higher. Just common sense. But it closes level, and then the next bar is a big down bar, and that's the one that really confuses people. It's so weak here that it takes out both of the lows of the previous days. And then we have a lovely little up thrust just here, just to really try and keep people locked in if they're panicking a bit. Don't worry, the market's trying to go up and it closes higher than the day before, and this bar here locks everybody into a panic situation, and suddenly either they're stopped out as the market falls, they're all confused because the news was good, and suddenly the market plummets away from them and they think, oh my goodness, what's happened? Now, again, professionals will at some point bring the price back up, but you'll then be able to look very clearly to see if they're interested in higher prices, and this, for me, is a much better entry and a much better probability trade to the short side. I will be frank, and I put it, Philip, to you as well. You and I would probably short the end of a rising market without really thinking too much about it, because we know the signal. And would you agree with that? Would you be or would you wait for confirmation on that?
I tend to probably be ultra cautious.
Okay.
So I may well wait.
And wait for the responses I'm about to show, and then come back up. Okay.
Yes. Having said that, if it's complete fresh new high ground and there's nothing else to the left, then I would probably be very tempted.
Tom and Philip, question for both of you. Wouldn't some professionals buy at a certain level or just to clarify, when there is professional selling, isn't that perhaps just the majority of the professionals, and there may some professionals may not sell at that moment? They're not all acting in unison.
Definitely.
That's very true. You see this very, very often. You see a clear accumulation on the lows, and the markets, you'll probably get a shake out before it starts, and then it starts moving up in a bull move. And then suddenly, in hindsight, you see halfway up, suddenly there's a huge bout of selling. Well, that means that one or more groups have decided to sell, and that usually knocks the market sideways a bit. There's testing going on, and one thing and another. If there's testing there, that means there are other groups in there that are still long, and then it goes on up higher. Professionals don't always get it spot on.
So even the smart money can sometimes be caught short-handed or and lose money. Well, I mean, obviously we know the story of Nick Leeson, wasn't it? I think it was Barings Bank. I mean, he was a professional trader. He was controlling large amounts of money, but he got it wrong. And so
yeah, well, he got it wrong. It's the most. Even the amateurs wouldn't do what he did. Apparently, he let the shorts run and didn't cover, anticipating higher prices. So that was very bad on his behalf. But see, when you look at the volume, activity, it's activity. The word volume means activity at the bottom. Then you say to yourself, what did the actual market do on that activity? Mm-hmm. And that's why the range, the price, is so important to us.
I see. Okay. So that's the end of a rising market. Do we have any questions from the attendees on the end of a rising market? Here, I'm just going to show you A and B because I want to talk quickly about these two bars here as you put your questions in. We notice that on bar A, the market tries to go up but collapses back on the low, closing lower than the previous day. Look at the volume. There is no professional interest to the upside on that bar. So that's your first indication, okay, your first warning that this is considerably weak. But this bar here is what we call no demand. We're going to talk about it next. And it's volume that's less than the previous two bars. It's an up bar, okay, closes higher than the bar behind it, and it's a very narrow range, okay. And because of the volume, it tells you again, as the price is trying to go up, professional money have withdrawn their interest. But what makes that bar and that bar such a great place to short is because that, in the background here, is still there. Professional money know it, and you now know it because you'll become VSA experts. So when you see that weakness in the background, now notice that weakness was back in October. We didn't try to come back up to approach this area until January. So you've got to be patient if you're a stock trader. It could take 2 or 3 months, and sometimes, yes, you say this looks great in hindsight, but it was there in foresight. And I went onto YouTube and put it up there. And all you're then looking for when you see that no demand bar, you wait for the next bar to close lower. Now, if you wanted to put an order in, you don't put an order in up here. You put a sell order below the no demand bar, because if you get a second no demand bar, it's not going to take you into the market. This bar here would have. Whoops. This bar here would have. Okay. So you've got no demand, and you put the sell order just below it. So you're not actually buying at market, and this is an important point. You're actually waiting for the market to collapse onto your order, and at that point you've got into the market at the right point. Do you agree with that?
Yes, Philip? I do. Yes.
Yeah, and this is one thing that we've not talked about a lot, but I'm going to stress today. When you see a setup like a test or a no demand bar, don't buy at market. Wait for confirmation. Put your order in below it, because if it's genuine no demand, which this clearly is, if it's genuine, it's in the right place. Okay, you've got weakness in the background. As the market falls through here, it will take you in. Now, again, if you'd have bought here, okay, and you've got in, you'd put your stop just above the high of the bar, and that's just where your stop would go. Not too far, maybe $1 above it, okay, just to lock things in there. Okay, so Morris makes a point here and says, aren't you in a short-term uptrend at that point from the December lows? You are. However, as you come down, you've had a strong downtrend behind you after the end of a rising market. When we start to go up here, okay, and get to point A, and the next bar collapses down, that's your alert. That is your alert that the market is not going to, in fact, it's almost like a mini retracement. But then, as we go black up, we never penetrate the top of bar A, and this happens quite frequently. Now, if you really wanted to wait for the trend to come back down, and know you're in a downtrend, then you could have entered on this bar here, because the market continues to fall, which again is an upthrust. As you get more experience, Morris, you would be happier to take that bar there because of this in the background. It's really, really a low risk trade. Okay. Hello, Brad. Good to see you, buddy, in Australia. Brad's here. Okay. Okay, that's great, Janet. No problem. Philip, does Philip think that has enough weakness on the low volume for that no demand setup? So on that no demand bar here, do you think that volume is low enough in comparison, or would you like it to be lower? This is on bar B.
Well, never try and look for perfection. What you're looking at is the setup, and it is lower than the two previous bars. You've got the immediate weakness in the background with that upthrust. You've also got a high to the left, which it's just hit up against,
Just
which
here.
is just to the left of the description there.
Mm-hmm.
And you are still in a longer term downtrend, because I'm looking further down there. I can't see any real accumulation taking place before that market's gone up.
No, and that does keep going as it happens.
Yes, so no, I would think that's good enough.
Yeah, okay. And again, sometimes you get the perfect no demand. That one for me was a strong setup because of the end of a rising market behind it. Okay, so I think we've covered. Let's just see if there's any questions here. Okay, Matt V, hello. Said, would you consider an entry on October the 14th? Okay, so October the 14th is going to be around here. Okay, below the low of October the 13th. Okay, just under here. Okay, well, you know something, Matt V? When we see the end of a rising market, it is a very strong sign of weakness. This is the safest place over here, but there are bars in here, like this bar here, the upthrust here. There's a little bit of not perfect no demand, but there's a hidden upthrust there. These are principles we're going to get to in a second. But yeah, where you enter your trade is going to be very much down to you. But this is the highest probability short that we see. There's a couple of others, but this, when it appears, is going to get you really looking at that chart very, very closely. Okay. But basically, the key to this, in my opinion, okay, is as you look down. And Philip, you said you would wait from here. Matt V was asking on October the 13th, 14th. So this was October the 14th. This is where this bar here was. Is there anywhere down here, Philip, you might have considered getting in as the market began to come down?
Well, I'm looking at the bar after the end of rising market, which actually is a test which has immediately failed. So that gives you an automatic sign of weakness on the following bar.
It does.
To add to the end of rising market.
Yeah.
So there's two signs of weakness there in the three bars.
Yeah. I mean, again, this is something that when you see this setup appear, as I said, you'll see it on. There are other examples, but this is a very good example. You'll see it. You'll see the market falling. If down here, as the market plummets, you get like no demand upthrusts. Now we haven't talked about that yet, Philip, have we?
Nope.
And no demand upthrust. They haven't heard that before, but we'll be showing you some examples of that today. But they do exist, and they are again a real confirmation of weakness. So that is the end of a rising market. Bar A and B are in the right place, approaching this area on an upthrust and then no demand, and then the market continues to fall, and it did indeed continue to fall. Okay, now when you're in a trade, Tom, one of the biggest problems that traders have is when they're in the trade is keeping with it. So let's say they're now short and they've taken the short trade. The biggest problem traders often have is they take the money off the table and say, look, I just made $1,000 on that, and then it keeps going. And it's the same with the top. The market's trending up, they take their profit because they see something, and it happened to me in New York. And then I took my profit and it just kept going. Now, you've got a way of avoiding that with your trending system.
Well, in a bullish move, in the past, I've had many people ring me up and say, well, Tom, yeah, I got in on the low there, lovely, but I sold out too soon. It's a very, very common thing that's going on with traders. So I thought, right, so I started looking at it more closely, and I suddenly realised that in a bull market, the close is inevitably higher than the close of the previous bar. Now, I knew this anyway beforehand, because if you're in control of a stock and you want that to keep going, you must not let the price fall, because you might lose control of it. Other groups will panic, and then you've lost complete control, and you'll lose a lot of money. So they make sure they support the market, so that you'll see that the close of the bar is always higher than the close of the previous bar. Now, saying that, you ignore bars that are relatively level or near level.
Sorry, you mean by the closing price we're talking about?
Yeah.
So if the closing price is closing level or near to level?
Near level.
Okay, let's just clarify that. Yep.
Yeah, near level, right, it's still trending up.
Right.
You allow for one down bar, and then that will keep you in the trade a lot longer than you think would normally stay in, until some very obvious sign of weakness comes in, and that we know that, which you just told us, massive volume on up bar. If it's a narrow spread, it's definitely a sell there, and that will keep you in that trade a lot longer.
Yeah, Scott made a point here, and he says, why wouldn't the smart money wait for JP Morgan to go higher based on the herd buying on the good news of earnings? Or is the smart money really in competition with each other so that they need to sell as early as other big money, and that behaviour is why the narrow spread bar appears? Is that right, Philip?
Yes,
So
they're definitely in competition with each other.
They're in competition with each other, and you've now got all the public and possibly some funds, you know, it could be everyone. You could even have some funds buying there based on what they see, and they say, oh, well, we'll go in, and professional money are unloading, or a lot of groups are, which caps the spread, which is why you've got that narrow spread closing in the middle. And then the next day, Scott, you see the bar closing level. You know that there has to be selling there. You've got ultra high volume on the up bar, the next day closes level, and the narrow spread. And what makes it a really good end of a rising market is that we had a strong bull run. JPM had been a bull run for about 9 months, and there was no price action to the left of us, if we remember that. So let's look at the trending system that Tom uses to stay in a short trade. Okay, and we're going to show you this on a chart as well. So, seeing a couple of questions coming in here. Yeah, okay, Howard, it says, good job so far. Please point out what are up bars and down bars. I will actually do that next. Chris, you're right. Chris says, you see the end of a rising market, unless it's pushing up through a trading range to the left. But the end of a rising market, you'll very rarely see, because of the spread of the bar, you'll very rarely see that being tested and go back up. It's very rarely because of the spread. Usually, Chris, you will see a higher volume up bar with a wider spread. Then you'll get a test back down into the spread. Correct, Philip? And that's more likely to go up. But when we get to signs of strength, Chris, we'll be able to see that clearer. Brad says the no demand on the 20th is the higher probability setup versus the entry on the 14th. In regards to it shows supply overcoming the strong bar on the 12th. Okay, we'll go back and look at that at the end. That's an interesting. What percent is near a level bar? You use your eyesight really for that, but is it within 1%, 5%? I'd say probably within 5% is acceptable on the range.
The human eye is very good at judging things like that.
Yeah.
The human eye. You're far better than reading a computer. Computers you can give percentages to and one thing or another. But the human eye, you want to make decisions within seconds, and you can analyse these markets literally in a few seconds. You'll find once you can read them.
Let's look at this chart, and we can actually go through this now and show what it. Well, let's first of all clarify for some of you who are fairly new what designates an up bar to a down bar. Now, when we have a down bar, it's a bar that closes. We're only interested in this little tick here, this little line. That's the closing price of the bar, Howard. And that is what we're interested in, the close. If the close closes lower, like this bar here and this bar here, then we call it a down bar. Let me be very clear on that. So a down bar is a price bar that closes, okay, we don't use the open in VSA. Tom, why don't we use the open in VSA?
Well, we don't use the opening. People only use the opening when they're using mathematical formulas. We don't use mathematical formulas at all. I saw one charting package I was quite alarmed at. I was looking at it, and there was a real clear drop in the market. Obviously, the whole lot was down. But when I clicked on it, it said this was up. So I thought, well, that's ridiculous. The whole lot's collapsed down and it says it's up. So I actually made some further investigations, and what they were doing was looking at the opening. If it opened at 10 and closed at 15, then it must be an up bar, which, as far as we're concerned, is absolute nonsense. Absolute nonsense.
So we look at the close because you see the result of the activity on the bar.
It's the results of the activity. seen by the volume below that we're really interested in. Couple that with the price spread, and
So-
coupled up where you are in the trading range.
Got you. Okay. Now, so we now know what a down bar is. We can see they close lower. Now we want to look what an up bar is, and that's very simple. It's the opposite. It closes higher than the bar behind it. And when we refer to volume spread analysis, we're looking at the volume, which is down here, which we can see high volume, low volume. We're looking at the range, and we're looking at the closing price. That's it. Nothing, not rocket science, but we are looking at the bars next to it. Now let's look at this downtrend. We can clearly see we're in a downtrend, okay, here. And if you're in an entry, let's read here what actually happens. Remember what Tom said. Now, at bars A, B, G, and H, we see the market going up on decreasing volume. Now, I just want to go back to the previous slide, and I want to just read to you here. Okay, let's just read this out. So we put it up there, but let's read it. This is the trending system to go short. Identify a serious sign of weakness first, such as we've just showed you. The end of a rising market, a buying climax, which we'll get to, which can be on ultra-high volume or low volume, okay, or up thrusts. Okay, low volume up thrusts, which we'll talk about, are very weak. These should be followed by what we call no demand, which we're going to show you. Wait for at least 10 bars in any time frame to see the result of the weakness. Sometimes it will be quicker. Okay, sometimes it will be quicker than 10 bars. Sometimes it could take 30 bars. So there's no dead set, it has to be exactly 10. So don't take that, write it down and say it has to always be 10. We're using a general term there because Philip and I have found, certainly I've found, that around 10 bars gives you a clue in any time frame. In a strong downtrend, we should see increasing volume, but not excessive or ultra high, on down bars, and decreasing volume on up bars. Okay. In a downtrend, you can allow for 2 up bars. Now think about this. The market's falling, each bar closing lower and lower, and then you get an up bar, a second up bar. We're saying here in the trending system that's acceptable, providing they are on low volume or average, but preferably low volume. Ignore the level bars or near level bars, as I'll show you on the schematic in a minute. That is a bar that has closed at or near the same price as the previous bar. The end of the downtrend is often seen by 2 consecutive up bars, followed by a test or no supply bar. So let's go and take this and put that into some sort of sense. The market's trending down. Okay. Now, as it comes down here, we get 2 down bars, then we get the first 2 up bars, as we can see. Okay. So this is where the real trend. This is a sideways move, but the trend begins here. So let's make an assumption that you're short somewhere up here, just for the sake of the lesson here. We have 2 down bars, which we know is fine. The first up bar appears, and then we get a second one, but the volume is getting less and less on the up bars. That's a good sign that lower prices are coming, because we're getting declining volume, okay, on the upside. And you really want to have, as we see in this example, some sort of weakness in the background. This is an up thrust on high volume. But indeed, you could have had there the end of a rising market or something else that's a serious sign of weakness, because something has to start the downtrend. And sometimes it will knock the market sideways before it hits. Other times it does it instantly, like we saw with JPM. So we now fall, we go up. Our first bar is an up bar, closes higher than the second bar here. So we've got 2 up bars, low volume, no problem. The next bar is down. We're fine. We have 1 up bar, we have 1 down bar. No problem there. Then we have another down bar. Okay, then we get our first up bar, the second up bar. But again, look at the volume. It's declining on the 2 up bars there. So if we're short, we're saying we may move our stop in a little bit, but we're not going to take the trade off. We then have a down bar, okay, and the next bar's down. Fine. Now look what happens in this area here, okay. C, D, E, and F, okay. We have increasing volume on up bars, but remember, okay, that we allow 2 bars, and at bar F, the price closes lower. So again here, although the market goes up on higher volume, if you kept with the trending system, you'd still be in there. Markets don't like high volume up bars like this, especially in a downtrend. Now, Tom, that really does confuse people. And I still want to get this past. We talk about low volume up bars, like at bar A and B, being a sign of weakness, which they definitely are with weakness in the background. But now I've got increasing volume, narrow spread up bars with this downtrend, And they're also weak, as we can see, because the market falls. Try and explain that, because this masterclass, this is one thing that we saw in the survey, was the confusion between a high volume up bar and a low volume up bar being weakness. But in this example, and in many examples that we looked at, you clearly see that's true.
Well, that is true. Now, in VSA, we don't really try to figure out all the whys and wherefores, because we know that all the final information has to be on that chart. The activity there amongst the consensus of opinion amongst the professional money, and the price bar. If it goes up and there's very high volume and the market's trending down, that's a sign of weakness. But if it goes up on no demand, it's also a sign of weakness. Now, you could probably make inquiries and figure out why the volume was high, who knows. But you'd probably be lied to. You'd probably never find out the real truth. But we know that that's weakness. High volume, especially if the spreads are narrow.
Like here.
As it goes up, and especially, of course, with narrow spread closed in the middle, we know that's definite professional selling. Who knows what they're doing? We can't keep battering our heads wondering what on earth is going on, because we can read the chart in a few seconds. So you don't want to get sidetracked. You want to concentrate on your trading.
Yeah, Philip, can you make sense here now? I can clearly see this. We get beautiful examples of no demand at A, B and G. But here you see, people can see, well, that the market tried to go up on volume less than the previous two bars. Look, here, there's the volume drying up as it goes up, because we've got this weakness here. Here, the volume's drying up as we try to go up. Here, the market tries to go up. Look, it closes in the middle. Look at the volume, less than the previous two bars. Next bar closes lower, confirms a weakness. But here, we get the spreads narrowing up. Look at this volume bar here. Look at the increase in volume, and it's a narrow spread. The next bar closes lower. So we have to know there's sellers there. But at the time, people see that price rising on that volume. Well, often think, oh, professionals are bullish now. They're buying, but of course they're selling. How do we explain that? How would you explain that?
Well, the way I'd explain that is, first of all, it's a mini mushroom effect there, actually. But if you look at all those bars, they're making very little progress to the upside.
And Matt V, so just say Matt V here said, C, D, E and F, failed effort to rise.
They're closing in the middle, and that's exactly what you've got. You've got an effort to push up.
Yeah.
There's some buying coming in there. There's an effort to push up, and it's immediately being hit with supply.
Sellers.
Yes, or sellers, and that is pushing it down and over.
So if you see that in a downtrend, especially with no demand in the background, you could add to a short position if you're already short.
That is, it's definitely weakness coming in there.
Yeah, pyramiding, Tom. You taught me about pyramiding. It's something that I do when I'm
Pyramiding,
trading.
yes, that's a very good way
which means
to
when I
make.
take a position, I take maybe if I'm not so sure, I take one contract. If it moves in my favour, I add a second and a third until I actually scale in or scale out of a position. Could you just quickly talk about that? That's how you do that?
Well, we used to do that. You'd accumulate, if you were actually buying, you'd buy at the lows, and then as soon as you saw extra strength coming in, you pyramid, you add to your position. That's a very common thing we used to do. But you shouldn't fight the market and try to figure out why. And that's why you shouldn't listen to rumours and stories, because none of them are true anyway. They're all kind of made up. They perhaps sound good, but if you've got high volume, narrow spread, up, that's weakness.
Brilliant. Okay. And we see here that's confirmed. Look, again at bar H, as we decline, we get the same thing. So if you see these things happening in a downtrend, as we've showed you here, that the market tries to go up as it does here, look on increase in volume, back down, up on no demand, that market's trending down. If you're short, don't suddenly, when the market rallies up on high volume like that, especially if the spreads are narrow, which we see here, and you see this a lot in the S&P and the futures contracts, you really want to resist taking a position off. Try and get your stop to break even as quickly as you can. That makes common sense. And let the trade run, because you're always surprised, aren't you, Tom? You said when a trend's in place, it always goes longer than you actually think it's going to.
Trends run longer than you think they will.
Yeah, absolutely. Okay, so let's now again have a look at the entries that you could take here. Okay, this is the British pound versus the US dollar. So again, it just confirms here where you would shorten a downtrend. This is where you actually take an entry. We look over here to the left, and we have very, very high volume on these up bars. Now this bar here brings the whole thing to life because the next bar closes lower. So you've got high volume here on these two up bars. This bar closes lower initially, but with the next bar surging up like that, closing off the high of the bar, and then this bar closing down gives you a clue there has to be more. There has to be more sellers there than buyers in that particular chart. Okay, so that's very, very important. And then we come up on lower volume than the previous two bars at bar A, and at bar B it closes lower, so we know there's sellers there. We come into the middle range here, and bar C comes down on an increase in volume. Okay, so we get, and we're going to explain that principle shortly, where the market's marked down on an increase in volume, and the next bar goes up into the bar on low volume. That's no demand. Okay, it's a weak bar at D, and it's the best place to have entered in this downtrend because the weakness has taken place. It's knocked the market sideways. This bar confirms the weakness because it's a high volume down bar, closes on the low of the bar. That's very important, by the way. We don't really want it closing off the low. We want it close on the low at the bottom here. That shows there's a lot more sellers there, and the next bar confirms it because it closes lower than that. So bar C is the bar that catches your attention. And then as the market goes up, I want you to look very carefully at the volume down here. Okay, we've got weakness here. It moves the market down here. As the market rallies up or tries to go up, the volume is very low and you put your sell order right below it. Now, if the market does drift up and it drifts up an even lower volume, if you put your order there, you still wouldn't be in. But all you'd then do is move your sell order up if the market keeps going up on low volume until you get the decline and then the market falls off. Now, just so you know, you'll all be getting a copy of these charts that we're showing you in PowerPoint, and you'll also be getting a copy of Philip's notes to take with you. You'll get them emailed to you later on tomorrow. And we're going to be doing a little quiz, aren't we, Philip? We're going to send you some charts on Monday where we're going to ask you some of these principles and get you to tell us what you would do. So be alert for that. Philip, would you agree that that was a good entry on that particular chart?
Yes, I would, yes. I'd also say, actually, that if you go back to A and B, you've got that area of serious weakness, which you've coloured yellow. Mm-hmm. And following that, you've actually got multiple testing, which has failed because you've got all that weakness behind you. You then get one bar, which you're just highlighting there, where you've got a little bit of buying coming in, and that's a countermanding signal. And that's the reason why the market just drifts upwards. But look how low the volume is as it drifts up. There's no interest in the upside. Mm-hmm. Sorry, yes, there's no interest in the upside there at all.
Yeah, see up here? This is what we're referring to. It's almost like it starts up here, and you can almost draw a line from there, which I should have done actually on this chart. If you just draw a line, and as the market attempts to go up, because there's a little bit of buying there, that's where Philip was talking about. Look, it's an increase in volume on a down bar, the next bar closes level, so there has to be some support there. But that support just knocks that chart up slightly before it decides to react and go down. Okay. Erica, hello, good to see you. Yeah, we're going to talk about this bar here shortly. Okay, so we're going to break in a minute, to have a 10-minute break. But I want you to just notice bar C. That does catch your attention. Why? Because it's taken out all the support bars to the left and the volume is high. Now, that's important, isn't it, Philip? Do you just want to explain when you see... We always say to people, well, high volume on down bars are mostly strength, but there are exceptions, and we're going to cover that today, which we haven't really covered in a course before. And we're going to show people why in the right place, a widespread down bar, okay, like this, and on bar C, closing off the low, if it takes out previous support levels, is a sign of weakness. Now, Tom, this is in your book as well, isn't it? Yeah, well, it is. Philip, it's in Tom's book. It's there. Yes. But I think sometimes people take things too literally, and they see the widespread down and maybe the next bar up, and they say, "Oh, crikey! Look, that's got to be climactic action. There's a big green signal on it because the software, the computer program sees that." But Tom, area of support, market's been going along. There's a bit of weakness. It hits support, and then suddenly widespread down, increase in volume, takes out all the support. That's weakness, isn't it?
I would say so, yes. I like to actually see a chart, clearly, 20 bars up to make a solid comment on it. But what you're saying is correct. It's all in that book I originally wrote. And I wrote that book, it must be 18 years ago now, is it? And everything in there still seems to be more or less accurate, what's going on.
Yep. Okay. Philip, there's a couple of questions here, and then we're going to break for 10 minutes just to give you all a refresher.
Just say, actually, that's the one point where you can have a down bar, which can actually be weakness.
That's correct, and we're going to show that, aren't we, shortly, where we get wide spreads down. I think it's the next one. Scott says it may not be the case here, but what if demand is lower on an intraday chart, in part because it is a slow part of the trading day, such as midday? Well, always remember, when we see... I was asked a question about Forex the other day, and someone said, look, Gavin, I'm sorry, but you get high volume when the market's open in Europe, Asia, and then you get, and in England and Europe, and you get low volume, at these times. And I said, that's correct. He said, well, surely that's all wrong. I said, why? He said, well, explain to me. I said, yeah, well, professional money are very active at those times. And they withdraw their interest. Not always, but sometimes they withdraw their interest at certain times. But Tom taught me, professional money doesn't go to sleep on the job.
Nope.
If they see an opportunity, they'll take it. And it might be at a time that you're not expecting it. Now, I'll give you an example on the futures contract last week. After market hours are closed at 3:15, Bernanke spoke and raised the bank interest rates. Do you see what happened to the futures?
I saw exactly what happened.
Now, everyone was asleep on that one, but I wasn't. And you certainly saw the market went down 7 points in about 5 minutes. So never assume that professional money have gone to sleep and they're not active. When they want to do something, they'll do it. I often heard that, at Christmas time and the New Year period, they're all on holiday. And yet you saw a lot of activity going on. And so you can't ever make the assumption, even in the Forex markets, that at times where you think that market's quiet, that they don't suddenly do something. And I can show you that here it is true, though. The Forex markets are very active during the European session, the Asian session, and the American session. And our Forex mentor, Brad Bedford-Brown, who's in here, trades the overnight session because he knows that the end of the Asian session, beginning of the European session, and the US session, which is all combined into about 12 hours, is incredibly active, which is why he teaches his course through those hours. There's a reason he does it, because he knows the volume's going to be there. High volume down should close off though to be strength. Yeah, Chris, what I mean by that, let me just be clear here. Okay, when we get a high volume down bar, okay, as it comes down, this bar closed on the low. See this one here? This took out all these areas of support, but it closes very, very close, almost on the low of the bar. That's the bar initially. The next bar, bar C, closes again very near to the low. And then as the next two bars go up, the volume is declining after we see the takeout of this bar. But in the next session, which we're going to start, I think this principle is covered.